Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, Jared Hoover from All Weather Capital, Grant Nader from Benguela Global Fund Managers. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV, #Stockwatch. Gentlemen, appreciate the time. I want to get into some companies and questions, but a great question came through that I thought we could perhaps start with. Grant, I'll start with you. HEPS, headline earnings per share, or earnings per share? And the question is, what's the difference and which one should I matter about? And Grant, there is a difference to them.
Yeah, absolutely there is. There's a lot of stripping out of one-off items, and are things exceptional or aren't they exceptional? But I feel like companies are taking a lot of liberties with those, and you get this other thing called normalized earnings, which is basically the core of the business. And you have to just read through which is which when you look at these things, because you often find the companies classify different things differently. So yeah, I always look carefully at which is which, and then you also want to know what's the difference between the two. What are the adjustments they've made to get from one to the other? Is it something fundamental, or is it sort of one off? So yeah, it's a good question to be asking.
And I like that point, is to understand why there is a difference. Jared, one of my bugbears is those normalized, and there's lots of other phrases out there, because that's just not an accounting term. I mean, it's not part of IFRS. But to the point being is, I suppose you always need to go and do the digging and find out why there is a difference in what they're doing. In other words, understand what management's presenting.
No, 100%. And I guess to Grant's point, what I've also seen is companies reporting earnings, headline earnings, normalized earnings, then core normalized earnings. It can get really, really confusing. And I guess each one is meant to tell you a different thing. And that's why for us personally, we do like to look at free cash flow per share, which in theory, I guess HEPS at least is meant to be a proxy for free cash flow per share. But you can typically find that these metrics diverge. But to really get a flavor for the underlying performance and where the cash is going, we like to monitor free cash flow per share and look at that historically and then also forward looking as well.
I take your point on that. And my favorite in America, they do GAAP and then they have non-GAAP. In other words, management just made it up. It's like, okay, guys, I see you there. Jared, let's stay with you a moment. Equitas Property Fund, results out today. I chatted with the CEO earlier. His, and I quote him, "We're in good shape," which I think is a fair comment. Exiting the UK, money coming back, lots of demand, long contracts. Your thought on results, but also on valuation, because it's trading at a fairly modest discount to NAV, which a lot of other property stocks got a much wider discount. Your thoughts, Jared?
No, 100%. We tend to agree with you. I also thought the results were more or less in line. But to your last point, it's just the valuation that is a bit punchy at about a 4.5% discount to NAV. It does look punchy, despite the fact that it's got about an 8 to 9% dividend yield. I mean, we did like the fact that they've managed to sell some properties in the UK, which doesn't seem to be doing too well, and then recycle it back into South Africa. But some of the other comments that we picked out was that in the UK, they're not managing to get that yield compression, so not starting to see those property revaluations come through. And the industrial property in South Africa is also a bit challenging. The demand there not necessarily coming through. So for us, I mean, yes, Equitas maybe more or less an inline set of results. Valuation does look punchy, but we like to look within the property space at maybe names like Tipula and like a Spear for our exposure.
Grant, your thoughts on the Equitas and the valuation?
I'm very happy that the UK misadventure is over,
yes.
Or at least some parts of it. I think the valuation is tight because they have a lot of longer term leases and they have a lot of high grade tenants. So they do these long term tie-ins with the likes of ShopRite, very specialized warehouses that they build. And so they almost have a slightly different like average lease term. Longer and so there is that premium built into the valuation. You don't get it at the same discount. but I think it also comes with less risk as well, certainly in SA operations. So I wouldn't be buying it at these levels given the discount. It's so narrow, but I think it generally does trade at a premium to others when it comes to a discount to NAV for the reasons that I've mentioned.
Yeah, and I saw that. I think the average weighted lease is just over 14 years because of that speciality they do with the retailers and the like. JC, Grant, let's stay with you. JC announcing Leila Fourie stepping down after 6 years. That's not the discussion point. The question I had coming through to me yesterday, does the stock offer value? And the logic was, we've seen, for example, the long-term insurers, the old mutuals, the asset managers and the like, a rising market benefits them. Does it benefit the JSE? Is there opportunity here for that stock in a market? Everything's at records.
I actually think that is the opportunity, Simon. I think the market's at all-time highs, and the JSE earns brokerage on the nominal value of that's traded, not on the number of shares. So they've had the declining listing issue. Luckily, we've seen a couple of new listings come on board. And then I think as this market rallies, it's going to suck in more and more participants. Retail guys will get involved again. It's been so long in South Africa since we've had a bull market that I think we're still getting going. And I think that could be the opportunity. The stock hasn't delivered anything for 5 years. I think it's done like 13%. If you take out, excluding the divvy, obviously there's a decent divvy there. I think it's an opportunity. I think it can benefit in a bull market, but it wouldn't be fundamentally a long-term hold for me. It would be on that basis alone.
Yeah, so when the market's going, own the dealer, I suppose, in a sense. Jared, JSE for you?
Yeah, I mean, I think Grant's covered it pretty well, but maybe just a few points from me. I mean, if you just look at the monthly volumes, typically there's pretty good correlation between the monthly volumes and the JSE share price. But we've seen a bit of a dislocation recently. I mean, monthly volumes have been tracking quite elevated over the last 1, 2, 3, even year to date, probably about 30% higher year on year, if I'm not mistaken. But to Grant's point, we haven't seen that reflected in the share price. So I think at some point the market does come around to that. And those volumes obviously have been helped by things like placements on the JSE from Valterra and the like. And we think that the volumes are elevated before you even consider passive inflows into our market. I mean, money is flowing away from the US and into the rest of the world. And South Africa must be a beneficiary of that at some point. So we think the valuation also looks pretty attractive. It is trading at about a 50% discount to other listed bourses across the world.
Wow.
So while we wait for that re-rating, I mean, it still does have a relatively attractive dividend yield as well.
Yeah, okay, man. I hadn't realized it was so cheap relative to other exchanges around. Jared, a question came through around food producers, and it's a bit of a mixed bag, and I'm staying away from the sort of the livestock ones, the eggs, the fish, the chickens and the like, more the Tiger brands, the AVIs, the RCLs. Question is, any food producers worth having a look at? I know Tiger Brands has had a stellar run. Any that are interesting you at current levels?
Yeah, I mean, when I heard you talking about food producers, the first one that came to my mind is Astral, but seeing as though you...
That's my next question, so you can hold that for now.
Okay, I'll hold it. But I mean, we do like Tiger Brands. We think it's a good execution story. I mean, margins, profitability, and shareholder returns have been improving on the chart. And I mean, he's also been divesting of non-performing assets, reinvesting back into the business, increasing the sales mix to general trade, using the cash to do share buybacks, pay specials. So I mean, we do like it, and yeah, I think that is something for one to consider.
For you, Grant, a food producer?
So I was going to go with Tigers, but that's been nabbed. So I do, for all the reasons that Jared said. But a stock that I think it's a bit illiquid, so we don't personally generally play in the space. But I quite like Rhodes Food Group. I think it's a good management team. I think they've stopped worrying about all the acquisitions, and they really focused on their knitting. And I think that could be one that's maybe worth a closer look outside of Tigers.
Okay, so let's go to Astral, because then the next question was, Astral worth buying as maize prices are well down, and of course maize is a big input. Now again, deeply cyclical, more so than in exchange perhaps, but worth having a look at Astral at current levels, because maize prices have created, and that certainly helps them.
Yes, absolutely. I thought you were asking Jared. Yeah, I like Astral at these levels. I think they've got a tailwind of falling input prices. They're going to capture a little bit of margin. For once, they don't have load shedding hurting them. The water issues are still there, but they've got a number of things behind them. And I think this is a highly cyclical business, and the cycle is moving in their favor. So, by all means, I think it's a good opportunity tactically to play Astral.
Jared, you were saying you do like it, and to the point, I mean, load shedding's gone. The water challenges are there, as Grant says, but of course they've learned how to live with those water challenges. Not lacquer, but a stark reality. Jared, you liking Astral?
Yeah, I mean, Grant's pretty much pointed to the key tenets of the investment case, and I mean, I would just say that all of the headwinds of the 23 to 24 years are pretty much turning into tailwinds now. I mean, the bird flu outbreaks are under control. Volumes are up to about 6 million birds a week. IQF prices are up about 16%, and I think you guys mentioned that yellow maize prices are falling. So naturally, you've got these historical headwinds turning into tailwinds across price, volume, and costs. So we're going to see those margins expand, and for those reasons, we do like Astral.
Okay, so Astral, and on the other side, Tiger Brands and some roads. We're going for a break in a minute. Before we do, Jared, for you, question coming through. I hold Advotech. Is it worth adding some Stadio or maybe Curo? Typically, the preferred from panelists is either an Advotech or a Stadio. If you had Advotech, would you add one of the others, or perhaps even add some more Advotech? Or maybe you don't like anything in the education?
No, we quite like the education space. I mean, they are fulfilling a need for quality education in the country. The top-down KPIs are quite strong for the education sector as a whole. We do like Advotech and we do like Stadio. I mean, Advotech, strong brands that allow strong pricing power, the likes of a Crawford and the likes of a Trinity House. The schools have also outperformed the likes of a Curo, where they've tried to push pricing historically, and that didn't quite work out as planned. And we also like the international expansion, which does provide an international kicker. And from talking to management, it does seem like they are quite aware of the risks of other South African companies and the risks that they face going into to Africa. And it seems like they're mitigating those around FX and around cash repatriation. So for those reasons, we do like Advotech. Yeah.
Grant, your education sector spec. I mean, everyone likes the sector. You've got a preferred.
Yeah. It's a good sector. I mean, I think in order, I would say Stadio probably number one for me, Advotech two, and then Curo third. Curo, of course, being taken out probably.
Yeah.
So I wouldn't buy that. Stadio, it's not cheap at the moment. Gee, it's had a heck of a run. I would wait probably to buy it. I think it's trading on 31 times earnings.
Wow.
It's phenomenal a business as it is. Great sector, great structural growth to be had, great management. Just, it does give you some chances. So I'd be a bit more patient on that one. But yeah, I would definitely look at adding when the chance arises.
Yeah, okay, that is quite the chart. I hadn't had a look at it, and it's been quite the flyer. But I take your point. It gives you opportunities at points, and I suppose grab those as they come. Grant, let's come back to you. A couple of questions actually coming through around from Afrimat. Results 2 weeks time. We had the trading update earlier in the week. Did seem to surprise a little bit to the upside, and the questions are simply, is this looking like a good opportunity at these levels? Lafarge was a big chunk for them to bite off. They have the reputation of being good at it, but they've got some other challenges they've had there. Grant, Afrimat for you at what, the low 40s at this point?
Yes, Simon, I think it is an opportunity, but I think it might require more patience than was originally expected. The cement acquisition has taken longer to bed down and to turn it around and stem the losses there. But they're making progress, and they have done with some of the other acquisition, the other parts of it. And they've had a lot of external challenges around, ArcelorMittal shutting down, and they've had freight issues. They can't export get stuff through the port. So some of it is external and some of it is internal. With regard to the internal, I trust this management team. They've been there, they've done that. I think they'll get it right, whether it takes a bit longer than we expected. And I think some of the external factors will pass, as often is the case. And so Yeah, I think it's worth a nibble at these levels. It is cheap and it's historically a good business and a good management team.
Yeah, it is. I mean, in terms of the acquisitions, perhaps one of the better ones out there, although Lafarge, and in their defense, and Andries van Heerden mentioned it to me, because it took so long to get the approval, it was in worse state than they had anticipated it being. Jared, for you, some Afrimat?
Yeah, I mean, maybe I'll just add one bullish point and maybe one bearish point. For us on the bullish side, I mean, on the cement side, we have seen gross fixed capital formation in the country be negative over the last 2 years.
Yeah.
But it does look like that may trend into a positive direction over the medium term. And if that does, coming off such a low base, I think that would naturally be positive for the entire industry, pick up utilization rates, pick up the margins, and maybe Afrimat would be a beneficiary to that. But maybe on the bearish side, I mean, historically, we have liked the management team. We think they've executed quite well. They are good proponents of capital allocation. But at the same time, we think that that kind of capital allocation umbrella maybe falls under a few heads under Afrimat. So that does create a bit of a risk for the broader company if those particular individuals had to leave and the like. So maybe more balanced for us and maybe one to just keep a lookout for, but just waiting for it.
Yeah, I like your point around the executives, and of course we'll get full colour in 2 weeks when results come out. I'm looking for a bank. What's the panel's preferred local bank? I hold a little bit of Capitec, but looking for more exposure into the sector. Jared, outside of Capitec, which is the darling, but you pay for it, what's your preferred bank? I mean, they're all quality in to degrees and of varying degrees of, I think, value. Your preferred?
Yeah, no, I mean, at the moment, I mean, ABSA does look pretty attractive to us. I mean, we've seen the leadership changes, quite strong leadership changes, as well as the new CEO bringing over a few of the good individuals over from Standard Bank. And we think that'll help and drive an increased focus on product level changes in the business and help to drive a steady improvement. We think we'll also see some efficiency improvements in the business as they start to improve the digitization across the retail banking space and probably a better integration of the African operations. And I mean, lastly, the valuation is really, really cheap. It's probably trading at about a 25% discount or so to the universal SA banking peers, despite a similar earnings outlook. And at the moment, the dividend yield is pretty high, almost touching double digits. So we think you are almost getting paid to wait for that re-rating and the executive changes to come through in the operational performance of the business.
Yeah, ABSA gives you more in dividend yield than it gives you in a savings account. Grant, a bank for you?
So my preferred pick would be Standard Bank and closely followed by ABSA for the opportunity that Kenny Fiesler brings. And Jared outlined all those opportunities. So I think that one could give you, if he succeeds with something of that turnaround, and he's got a track record. He's been there, and Africa's really the opportunity there, and he's bringing people in from Standard Bank. So I think that could be a great opportunity. But in terms of a higher quality, I think Standard Bank is doing a better job currently. They're operationally doing a great job. They're driving both growth through Africa. They are by far the best operator in Africa, and of course still doing a good job in SA. So that would probably be my safer pick, or so I'd probably pick both if I was the one asking the question.
Gotcha. Okay. Great question coming through around race. Ferrari. Poor results out. Stock is falling and it is 15% down today. Is it worth looking at these levels? Grant, what about Ferrari as an option? I don't know about you. I certainly can't afford the cars, but maybe I could shell out $400 for a stock.
Looks like it's going into the pits, huh? I think it's a very good business. It's traditionally been incredibly defensive, and let's be honest, there are more and more millionaires every day in the world, more and more billionaires, and who knows what's coming next after that. So I think their target market will always be there. They've got a brand. It's just like Cartier jewelry that Richemont has, or LVMH, the Hermes bag. You can't create that brand overnight. So I think it's a good business. I don't think it's cheap. Even I think it was 40 times earnings before this fall or something like that. So you're never going to get it cheap, but it trades expensive because of the quality and the defensiveness of the demand there. So I think in a world awash with money, it would be fine to own this one, but your return expectations have to be moderated by this price you pay.
In other words, like being a fan of their F1 team, they might have the best. I always say that there could be 2 Ferraris on the grid and they'll still come third somehow because of, yes. Jared, a Ferrari for you?
I love the cars, but I do like the equities in general more, not quite the Ferrari equities anymore. I mean, Grant did mention that the valuations are still pretty punchy, even though you've had a 15% fall in the stock trading at over 40 times. I think historically we have liked the business model. We think there's a place for them, there's a target market for them, and they've benefited from the somewhat captive market with the 2 to 3 year order book that allows them to push pricing ahead of peers. But we're just not so sure that they've been able to do that anymore, and I think that started to impact probably the guidance levels in the outer years. And for that reason, I mean, if we think about Ferrari more in the luxury bracket, if you will, we think in that particular cohort of stocks, we might find other more appealing names, such as like a Richemont, trading on about a mid-20s valuation level with a similar earnings outlook. So we just think there's other opportunity within the broader luxury space if one was to bucket Ferrari there.
Yeah, but it's not a Ferrari, man. That's the whole point of it. But I take your point.
Bragging rights if you have it in your portfolio.
Yeah, maybe one day I get an invite. Jared, let's stay with you. An interesting question. Is it worth looking to bonds as markets are expensive? And I have lots of thoughts and concerns. One is, are markets expensive? Sure. Can they go higher? Well, they've been expensive for a while. And of course, bonds are a whole different profile. Would you be, as an equity, saying, hey, maybe I need some money off the table and lock in some bond? Or is it, you know what, you just manage the equities and the valuations, and they are bubbles that come along with it?
Yeah, I mean, that's quite an interesting cross-asset question. But I mean, if we were to bring that question maybe closer to home into South Africa, I think bonds have actually rallied quite a bit. I mean, if we look at where they were trading pre-GNU up until now, probably about 350 basis points lower, and that implies that the prices actually rallied. So I think in South Africa, I don't think the bonds are necessarily looking that cheap. But if we had to compare to the equities, and we compare it maybe to SA domestic stocks, the likes of the banks and the retailers, we think there's value to be had there. And I mean, typically there's a pretty good correlation between bond yields and SA domestic valuations, and we are starting to see a disconnect right now between the retailers and the SA Inc. stocks and the banks and that bond yield. So we actually think there's more value to be had if one was to look within the SA domestics. And I mean, we mentioned it in the first half of our call that ABSA does look pretty interesting.
Yeah.
So I mean, maybe that's the way to play it rather than looking at the bonds right now. So we're not saying that we don't like the bonds. We're just saying we think that there's a more attractive case to be had in the SA domestics right now.
And if we take it back to ABSA, I can get a dividend yield the same as the 10-year, and I've got ABSA, so I'm going to get potential growth. Grant, I mean, that is the trick with bonds. They look attractive, and then, you know, I bought some in the early days of the pandemic, 11.5%. It felt really clever. Now it doesn't feel so clever.
No, exactly. And as Jared said, most of the juice has already been squeezed out of the lemon. Our 10-year, the long bond rate is as good as it's been in years. We've had a tremendous rally. So I think that's taken. Now, if you want yield only and you want safety, you don't want the volatility of a stock price, okay, put some in bonds. But you can still get volatility if the yield gives up, you know, if we have a bit of a shakeout. So it's not even that safe, but unless you hold it to maturity. But I think, you know, what is the question around the portfolio? You've got to look at your mix in your portfolio. What's your timeline? If you're about to retire and you're holding a lot of equities, maybe put some in bonds. But if like me, if you just turned 30, you hold on into your equities, you've got 30 years, 40 years ahead of you. You know, don't worry about investing too much in bonds unless it's part of your core long-term asset allocation. Yeah. So it's an asset allocation question. It's got to be looked at in timeline, risk tolerance, etc. It's not a simple question. I would not be rushing into bonds is my short answer. Foreigners have been buying our bonds, by the way, and I think the next leg is SA Inc., as Jared said. Yeah,
I think you're right. You're 30, so you're young. I mean, Jared's probably 12 and got even more decades ahead of him. Let's go to some stock picks. We actually had a question around Discovery. They had a bit of an update today. Grant, that is your pick. It had a good day in the market as well.
Yeah, I like it. We have liked it. the question came out in their last set of results was what's happening with their new business margin?
Yeah.
Are they losing some volume in some of the core businesses in SA in the healthcare and life space? Today they put out they updated the market and it allayed a lot of those fears, talking about recovery in that margin and around new business. And so I think that's put that concern aside. And outside of that, you've got this core growth story that's building out. The bank is starting to turn profitable. They don't need to pump so much capital into that. And you've got some of their global businesses that are also, growing at a healthy clip. UK is doing very well. So I think you've got a stable core business, traditional core business, plus a number of growth drivers that have been built that are now starting to hit their straps in the rest of the business. So I think you're going to get mid-teens to upper teens growth in the next 2-3 years in earnings. And you're paying, on a forward earnings basis, you're paying like 12.5 times, 13 times next year's earnings. At that rate, I think it's pretty attractive. So that's my pick of the
nice numbers. Jared, you're going with SAPI, which with the Monday update earlier in the week, SAPI got absolutely slammed, and you're saying opportunity here.
Yeah, I think if you look at SAPI, it is a very cyclical kind of equity and very cyclical kind of business. And if we look at it on normalized earnings power, we think the equity is trading very cheaply. It's probably only ever been cheaper during COVID when it was going through a period of balance sheet distress. And we think, yes, it probably does deserve to be cheap at this point in the cycle, given some of the cyclical headwinds it is facing across the segments along pricing and volumes. But having said that, post the Mondi update, we think SAPI did trade in sympathy with Mondi, but more a case of if one had to think that the free cash flow generation wasn't necessarily going to be there, then maybe SAPI was trading with a bit of balance sheet distress. But to us, we think that those fears are overblown. We don't think that there's a balance sheet or a liquidity risk that is imminent in the business. We think management are viewing the balance sheet and the liquidity issues as something that's at the top of their agenda.
Yeah.
And we do expect them to resolve that in the short term and therefore see a bounce in the equity.
Yeah, actually, I hadn't noticed it. I had a strong day yesterday after, as I said, a bit of a bloodbath and sort of sympathy with Mondi. But that's all for Stockwatch today. Thanks to our guests, Jared Hoover, All Weather Capital, Grant Nader, Benguela Global Fund Managers. Up next, the close. Stay tuned.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.